All right. So 9 Dimes Project, investing in your teens and 20s and exactly where to put your money. All right. So investing in your teens and 20s is the single most important financial decision you'll ever make. $1 invested at 18 is worth more than $5 invested at 40. Today, we're giving you the exact blueprint for where to put your money. It's not even complicated. You don't need to pick stocks or time the market. So, we're not financial advisors, and this isn't financial advice, but we wish somebody had laid this out for us at your age. 15, 16, 17, 18. Yeah, this would be a whole new, it opens up a whole new world. If I had have done this, I wouldn't be here now. I wouldn't be an educator, not like this. All right, so why starting now matters more than anything. Here's some math. $500 per month from 18 to 28, 10 years, and then you stop contributing. You still have $1.6 million by 65. $500 per month from 28 to 65. You have 1.4 million by 65. And starting 10 years earlier with 27 fewer years of contributions equals more money. Read that again. Time is your superpower. You can afford more risk when you're younger, decades to recover from any crash. The market crashes. If the market crashes at your age, 15, 16, 17, 18, anywhere in that young adult age equals buying opportunities. Compound interest needs time above everything else. So the regret factor is the number one regret of unks like me is I wish I would have started sooner. Not I wish I would have invested more, I wish I would have started sooner. And you can't get those years back. So where to put your money? If you're under 18, custodial Roth IRA. If you have earned income from a job, self-employment, you'll need a parent to open it up with you, but it's still your money. Custodial brokerage, a UTMA, a UGMA. And we'll go over more of that in later videos. There's no income requirement, and your parent manages it until you're 18 to 21. So it's just it's an account that you open. Like, say if you have a child, and you just open one of those accounts, and then just put stock money away for you. And also, there's a high yield savings account you can use for emergency funds and short-term goals. Now, if you're 18 or older, you can open your own Roth IRA. The max you can put in changes from year to year. I think this year it's definitely over 7,000 you can put in. Well, you pay taxes on it. You pay taxes on the money before you put it in, and you never pay taxes when it's in there. All right, so it's the best account for young people. And again, you can open it Fidelity, Schwab, Vanguard, brokerages like that. Your employer 401k match, if your job offers it. You get the match, it's free money. Let's say they do a 4% match, it's 100% return for you. And you can max out your 401k, and that number changes year to year. And step 4 is a taxable brokerage account for money beyond your retirement accounts. So what to buy and how to automate it. So we're going to keep it simple. The one fund solution. Target date fund, let's say 2065. Automatically diversified, automatically rebalances. You set it and forget it. The 3-fund portfolio, if you want more control, you do U.S. stock market index 60 to 70%, international stock market index 20 to 30%, and bonds 0 to 10% when you're young. And specific funds are the VTI, the VTSAX is a Vanguard total stock market, VXUS and the VTIAX. It's the Vanguard International, and Fidelity has equivalents. Schwab may have something similar. So this is what you don't do. You don't pick individual stocks, or you'll underperform the index. Don't try to time the market. There's nobody can do that. Hasn't been proven, don't think. Don't invest in things you don't understand, and don't check your account every day. So you can automate this whole thing. You can open your accounts. Takes like 10-15 minutes and set up an automatic transfer from your checking to your Roth IRA. And then you do something like $250, $350 on your paycheck, whether you get paid weekly or bi-weekly. You choose your investment, set it once, and don't touch it. Don't check it daily. Don't panic when the market drops, because it's gonna go back up. Don't sell when you're scared. Check quarterly at most. Every 3 months, whatever. So your dollar cost averaging smooths out the ups and downs. And automation removes the emotion. Time in the market beats timing the market all day long. All right. So we have our free wealth building tools. The link's in the description. Have you started investing yet? If not, what's stopping you? And on Monday, we're going to lay out $100,000 net worth plan. But I want to show you something before we head out. Let's see here. All right. This is showing you the path to $1 million or more by age 38. If you're starting at this 18, hold on, let me unlock this. Let me get this out of the way. Hold on. Struggle streaming. All right. So you start at 18. Let me move my fat head. All right. So start at 18. You're doing $500 a month. 18 to 20. Then when you get your big job, or you started this business, 21 to 24, 12, and you're putting in $1,200 a month. Then age 25 to 28, you start putting in $2,000 per month. All right. 29 to 32, $2,500 per month. You're building up. You got, and then at 33, you got $500K. Then age 33 to 38, you're putting in $3,000 per month. And then boom, at 38, you got $1 million plus. That's the math. You've invested between 18 and 38, you've invested $507,600. And then with the interest, $537,543. And then bam, you're well over $1 million. And that could be you. If you follow that. All right, so I'm going to see you on Monday. Start building wealth. Peace.